This video will provide a comprehensive guide to the Bollinger Bands indicator, a powerful tool for trading breakouts, reversals, and pullbacks. In this video, you will learn how to create high-quality trade entries using this indicator, and this will help you that will be watching this video to be an expert in the process. Market trends are crucial, but they don't usually move in a straight line. Instead, they often appear with higher highs and pullbacks, which can lead to false signals. For instance, a normal trend indicator like the 20 EMA would give a perfect signals if trends were moving in a straight line. However, with pullbacks such as those in a trend, it can lead to numerous false signals. So Bollinger Bands is a better indicator as it can identify the direction of a trend while considering these pullbacks, resulting in less false signals. By following this guide, traders can effectively use the Bollinger Bands indicator to identify and trade market trends effectively. If you happen to find value in this video, then go ahead and click the like button, subscribe, and turn on the notification button to get notified when we upload a new video. The Bollinger Bands indicator is a powerful tool for analyzing market volatility. But before we dive into it, let's first understand what volatility means. Simply put, volatility refers to the speed at which price moves. The market doesn't always move at a constant pace. Sometimes we see periods of low volatility, where price moves slowly over time, and other times high volatility, where price moves rapidly. In this video, we'll cover everything you need to know about Bollinger Bands. First, we'll break down the basics of the indicator, including how it reflects market volatility. Then we'll explore 3 simple yet effective trading setups using Bollinger Bands: pullbacks, reversals, and breakouts. Let's get started. In low volatility environments, price movements are small and unorganized, with tiny red and green candles showing little momentum. These conditions are often referred to as sideways or range-bound markets. Trading during such times can be challenging since price movement is minimal. However, because the market behaves in a somewhat predictable manner, small calculated trades can still be taken with proper strategy. On the other hand, high volatility environments are marked by rapid price swings, large candles, and strong momentum. These conditions are often seen in trending markets, where price moves quickly in one direction. While trading in high volatility markets can be easier, it requires a more aggressive approach, as price can change direction suddenly. In short, low volatility markets call for a cautious, conservative trading style, while high volatility markets demand quick decision-making and aggressive entries and exits. Understanding these differences can help you adapt your trading strategy to current market conditions. So how do we identify market volatility? This is where Bollinger Bands come into play. The Bollinger Bands indicator is specifically designed to measure market volatility with ease. It consists of 3 lines and is typically set to a 20-period default, though you can adjust it to 25 periods if needed. These bands are based on 2 standard deviations from the middle line, which is simply a 20-period moving average. The upper band is calculated by adding 2 standard deviations to the middle line, while the lower band is calculated by subtracting 2 standard deviations. In low volatility environments, the bands contract and become extremely narrow, with price moving sideways within them. During these periods, price tends to bounce between the upper and lower bands, staying within their range. When the price closes above the upper band, it often reverses downward, and when it closes below the lower band, it tends to reverse upward. In high volatility environments, the bands expand significantly, and price moves aggressively near either the upper or lower band. This widening of the bands signals strong momentum and potential trend formation. By understanding how Bollinger Bands react to volatility, traders can better anticipate market conditions and adjust their strategies accordingly. In an uptrend, the price tends to stay close to the upper band, occasionally closing a few candles above it without immediately reversing. Similarly, in a downtrend, the price remains near the lower band, with some candles closing below it without triggering a reversal. This behavior helps confirm the strength of the trend. By observing how price interacts with the bands, traders can gain a clear understanding of market volatility and momentum, making Bollinger Bands a valuable tool for market analysis. If you follow a trend trading strategy, it's best to avoid trading when the Bollinger Bands are narrow. Instead, focus on trading when the bands are wide, as this indicates strong market momentum. On the other hand, if you're looking to trade reversals, you should avoid entering trades when the bands are wide. Reversals are more effective when the bands are narrow, signaling a low volatility environment before a potential breakout. That said, you shouldn't rely solely on the size of the bands to make trading decisions. A well-defined strategy with clear rules is essential for consistently successful trades. Here are the basic setups using the Bollinger Bands. The first one is a pullback setup. Pullbacks are one of the simplest and most effective ways to trade using Bollinger Bands. To trade pullbacks within a trend, we first need to determine the market direction. If the price is moving between the middle band and the upper band, the market is considered to be in an uptrend. In this case, we look for buying opportunities when the price pulls back to the middle band. Conversely, if the price is moving between the middle band and the lower band, the market is in a downtrend. Here, we look for selling opportunities when the price pulls back to the middle band. By using Bollinger Bands to identify pullbacks within trends, traders can enter positions at optimal points, increasing their chances of success. The second setup is the breakout setup. A breakout occurs when the price breaks out of a sideways market and transitions into a trend. If you enter at the right moment, you can capture a significant move with a tight stop loss. Bollinger Bands can help identify the ideal breakout points. To spot a breakout opportunity, follow these steps. The first step is to identify a sideways market. Look for areas on the chart where the Bollinger Bands are relatively narrow, indicating low volatility. During this phase, the price should be moving sideways within the bands. The second step is to confirm price containment. Ensure that the price has stayed within the bands for most of the consolidation period. The upper band should act as resistance, while the lower band should serve as support. As we wait for a breakout, we then notice a strong green candle that breaks and closes above the upper Bollinger Band. Since price typically moves within the bands, a breakout like this signals a strong shift in market momentum. This confirms a valid bullish breakout setup. Now let's look at a bearish breakout. First, we identify a tight sideways range where the Bollinger Bands are squeezed and narrow. The price moves sideways for an extended period, with the upper band acting as resistance and the lower band serving as support. This compression signals a buildup of potential energy. To confirm a breakout, we wait for the price to break above or below the range. Eventually, a large red candle breaks and closes below the lower band with strong momentum. This confirms a valid bearish breakout setup, indicating a shift into a downward trend. Now moving on to the third setup, which is the reversal setup. So the Bollinger Bands can be used to trade reversals with high probability. As we discussed previously, the price will remain inside the Bollinger Bands for most of the time. Therefore, whenever the price breaks or touches the upper or lower band, we can expect a reversal. Let's first understand the sell setup. Here we see that the price was in a sideways range trading inside the bands. The upper and lower bands held the price inside them. On this candle, the price touched the upper band and immediately reversed. Then it went down to the lower band. The price once again touched the upper band here and reversed immediately. This time as well, the price goes on to touch the lower band. Here is a bullish reversal setup. Here we see that the price touches the lower band on this candle, and it immediately reverses and moves upward. The price goes on to touch the upper band here, so we can say that the reversal setups also work well. Now these are the three key Bollinger Band setups: pullbacks, breakouts, and reversals. If you want to trade effectively using these strategies, it's important to combine them with additional confluences to increase your trade success rate. These confluences can include support and resistance levels, candlestick patterns, trend lines, and more. Please, you all should go ahead and join my free Telegram channel because we will be going hard on Forex trading, and if you want to be part of my community, just join this Telegram channel. Again, I have created a premium VIP signal channel where I will be sending high-quality trading signals. So if you want to join the VIP channel, just send me a DM on Telegram. By the way, don't forget to click here and create an account with this Forex broker, because they are currently one of the best Forex brokers in the Forex and synthetic industry. Now, if you know another trader that might benefit from this video, please share it out with them, and let us know in the comment section below the concepts you would like to see covered in the next video. Please don't forget to smash the like button and subscribe to our channel to get notified when we upload a new video.